Well, you mean, well, let me tell you, with respect to whether or not there's insurance, they look at it cell by cell. So within the cell, they say, do you meet all those tests we had up there? And if you do, then the payor of the premium gets a deduction. So now there's a second part of that. You've got the recipient cell. Does the recipient cell have income? And does the recipient cell have to test whether or not it meets the test within the cell walls? And the service in 2008 said that's the way we're leaning. Right. In 2010, they put out proposed regs that said the very same thing. We're going to do it on a cell-by-cell basis, and everybody anticipates that those regs will be finalized, and that's the second thing that's on the business plan. And if they're finalized, what that would mean is each cell could will have to get its own EIN, will have to file its own tax returns, but can make its own elections, can make its 953D election to be taxed as a U.S. taxpayer, and can make its own 831B election. Now, the advantage of that, if you're doing everything right, is then you don't have to worry about your cellmates. I mean, they may have done everything wrong, but they're not going to adversely affect you. Now, there's a grandfather rule if historically everything was treated as one big enterprise, and their grandfather rules, it's kind of tough to meet those rules now. It essentially means that everything that you were doing as of September 14th, 2010, you had to keep in place and not change.
So if you've added cells, you've probably blown the grandfather.
Right. Or if you started up a new cell structure or Series LLC since then. By the way, Series LLC follows these same cell rules. The other thing, when we test this 50%, the IRS has asked whether or not it matters whether or not the related coverage and the unrelated coverage are the same kind. That is, can you do employee benefits and get your unrelated business and then tax property or liability for your related? And the service hasn't answered that question officially. The industry said, no, just look at it from one big enterprise, which actually helps taxpayers normally. The tax-exempt group within the IRS has said, nope, you have to look at it on a line of business by line of business basis.
But don't you think that's probably because if you look at most all the rulings that the services issue, they all say business is considered to be homogeneous.
Right.
So they've set that out, and I think tax-exempt, when they're looking at it, reads through that ruling, sees that, and thinks that's a very important aspect of it.
Yeah, and candidly, I think it was result-driven. Again,
could be.
I don't think that it bleeds over from the 501c4 controversy we've got now, but I think that sometime within the service, when you have a conclusion that you think is right, then you use every argument, and lawyers do that all the time. It's not just the service.
Make the facts fit the results.
They use every argument to bolster the response. All right, we keep on talking about this brother-sister. Tell me about it.
Well, brother-sister, what we're referring to here, and we're using a parent. This is just a typical consolidated group, and you've got the parent organization, and then you've got a number of operating subsidiaries that are actually really doing something other than just holding the stock. And they decide to set up an insurance company down below. And it's a sister corporation